So next we're going to look at the market prices for stock in general. We look at intrinsic value versus market prices. You may recall way back in chapter 1, we looked at this notion of intrinsic value, which is what the company is worth, right, in some kind of theoretical sense. We're going to look at the intrinsic value where on the left side, we take into account all relevant information and we crunch it through a bunch of analysis and we end up with an intrinsic value. What is the company really worth? Now the right side is the market. The market is looking at what's out there and available, and it's perceiving the future cash flow, it's perceiving the future risk. Those kind of work together to get at a weighted average cost of capital, and we would determine the market price. So the question is, are they equal? And the answer is not always. Okay, so how does this work as far as the invisible hand of the marketplace to reach the equilibrium price? So if you think about it, if the market value is lower than the intrinsic value and you know that, you're going to start buying it at the market and it'll bid up the price from the lower price now to the intrinsic value. And so that's what would happen in that scenario, and we would then move toward an equilibrium price. And the opposite is if the market price is higher than the intrinsic value, then people who are opportunists will sell at the higher price knowing that it's going to come down. So we call that selling short. They're going to sell high, wait for the price to drop, and then cover their positions and make that profit. Either direction, if the marketplace believes that the intrinsic value is not equal to the market price, it will bid up or down, and ultimately there's the equilibrium. And that's kind of how the invisible hand of the market works. When we say the efficient market hypothesis, it's really guessing at whether you believe that the market price is correct or not. Because if the market were purely efficient, at any point in time, every single price is perfectly priced. And so obviously there's a whole bunch of, maybe not controversy, let's call it friendly academic discussion on how efficient is the market. So we're going to look at a few different hypotheses about the market. And it says basically that the marketplace absorbs and factors information in very, very quickly. And part of what drives it is that we have so many people looking at it. We have analysts, we have investment companies, we have pension fund managers, we have individual investors. When there's a mispricing in the marketplace, it reacts very quickly. What this again states is that in general, the market is at equilibrium, and when it's out of equilibrium, there's enough action to drive it toward the equilibrium price, which is the intrinsic value. So that's a general idea about efficient market hypothesis. There are different forms and degrees, if you will, of how efficient it is. So weak form has the idea that current prices reflect all information that is in the past. It's kind of a chartist approach. We can then look at historical patterns of the price, see how it moves up and down, look at tendencies, and we call this technical analysis. In this weak form, it's kind of backward looking at the historical prices and looks at that to create some opportunities in the current pricing. So we see that there's some evidence for weak form because there's some strategies where you could earn a little excess return, right? So there's some evidence for some weak form, and that's why there's a lot of technical analysis. That's why we have automated trading platforms, things of that sort, to take advantage of these small anomalies in the price of stocks. The semi-strong is that current prices reflect all publicly available information. And so again, it's efficient and your extra work is fruitless because it's already been factored in. This is kind of fundamental analysis where we say we do full analysis looking at the past, looking at all information, and we interpret what that might mean for the future. And so there's some evidence again for semi-strong. What we look at here is what is the performance of investment managers? There's a whole community or industry of financial investors that are portfolio managers. And although some will beat the market from time to time, it's pretty difficult for a portfolio manager to consistently beat the projected returns from capital asset pricing model. So we can see that there are exceptions, and they're kind of like the superstars, at least for a little while, but over time it's pretty hard to consistently beat the market. The last is a strong form, and this is where you say all information, both insider information and external information, is in the price. And this one actually cannot be true. And we have plenty of empirical studies showing this is not true, basically showing that insiders know things, and until that information is released, it's not factored in the market. So once it's released, we have this dramatic move in the market price. So that is a simple explanation of conditions that refute the strong form efficient market hypothesis. Then occasionally we see that there are bubbles where, like the late 1990s, early 2000s, there was definitely an internet bubble. And so prices got unusually high, and all of a sudden the bubble burst and the prices dropped precipitously. It's undeniable that there are bubbles, but those are based on kind of market-wide mistakes or misestimation where everyone kind of believed the same set of facts, which turn out not to be facts, and then the collapse occurs. Obviously, that occurred in the internet bubble. That also occurred spurred by the whole mortgage crisis on kind of the safety of the capital markets themselves. Next is we want to say, well, what's the bottom line, right? So for most times, for most stocks, the price is reasonably set and the markets are efficient. So this is why I don't advise that you guys all spend your entire net worth doing stock investments, because in general, the prices are correct. That means in general, you have kind of an equal chance of the market going up or down. Most investors now don't try to beat the market, so they buy diversified portfolios. And so they may diversify from an active manager, like a mutual fund manager, or they might just buy the market. One simple example of buying the market is there are index funds that are constructed to exactly mirror the S&P 500. So if you believe that the S&P 500 will rise over time, which it has for 90 plus years, then in the long run, it's smart to buy the S&P index and let it rise. It may go up and down, but it will rise. Similar to today, right? We're at near all-time highs. We hit all-time highs and it dropped back a little bit. But in time, it has been shown that the markets are a good long-term investment. And so that's kind of the basic philosophy behind a lot of retirement planning. CAPM, what's the bottom line on it? Well, the empirical evidence is that it's pretty good, but it's not perfect. And that when we try to estimate something as nebulous as a share price or market behavior, it's difficult to do so. There have been multi-factor models that go beyond CAPM that have some slight improvement over the results of CAPM, but investors tend to use it as a good rule of thumb, and it drives a lot of decisions as kind of the best thing we have right now as a general practice. So you'll find many companies utilize CAPM as a means of determining their required rate of return from their shareholders. The summary for Chapter 6 is that when we look at risk return, we look at some statistical measures. What is the expected value of return? And the risk is defined by the variability or the standard deviation. And then standalone risk looks at one particular investment and looks at the return and risk of that one investment. Then we make it a larger pool and we diversify through a portfolio. So then we take the weighted average of those various components or investments that comprise the portfolio, and we get to a portfolio beta and a portfolio required rate of return. And when we look at CAPM and the security market line, it's a very useful tool to do assessment of individual stocks and portfolios that help us understand the movement of the stock market and portfolios. And finally, we cover different theories and proven empirical studies on the efficiency of the market and the kind of the general conclusions. The markets are pretty efficient. Maybe not 100%, but they're highly efficient enough so it's very difficult for any lucky or intelligent person to systematically and consistently beat the market. So in general, the market prices stocks correctly. All right, so that concludes Chapter 6, and I will see you in class. Bye-bye.